Ralph Sass, and this is Accounting 211, and this is the second part of the lecture for Chapter 3. And I'm going to go ahead and begin where I left off. Remember, we've got these general ledger accounts, and there are buckets, if you will, and we're keeping track of all our transactions that impacted cash. And notice this general ledger account, as I've already pointed out, is really our T account. Okay, it's right there, and it's showing our T account. Keep in mind this is a running balance, and over on the far left, it is showing that the balance in the cash account is 28 grand. And notice that it doesn't tell us that it is what the balance is. It doesn't tell us if it's a debit or credit, but we know that since it's cash, and cash is an asset, that balance has to be a debit balance. Moving on to net income. Net income, as income is earned, either an asset is increased or a liability is decreased. When we sell something, and let's just use selling something or providing a service, cash can go up, which if cash goes up, an asset went up. They could owe us the money, which means accounts receivable went up, which is an asset up. Or liabilities can go down. And this is interesting, and we're going to come back and talk about this in Chapter 5, I believe it is. But the key here is, suppose they prepaid. Suppose somebody paid me $1,000 for some services that I was going to provide over the next 2 months, and now I've done some of them. In essence, what happens when somebody prepays is you owe them the service. So that's a liability. And as you use up that service, what's going to happen is that liability is going to go down. This happens all the time. I bought a plane flight just the other day, and I paid for it, but I haven't flown yet. And so until I get on that plane and fly, they owe me that flight. And because they owe me that flight, they have a liability. And only when that plane takes off in a couple of days are they going to have earned that. And then will that be in part of their net income. But right now it's a liability because they owe me that flight. The other part of a net income is an increase. Okay. Whenever there's net income always results in an increase in the owner's equity account. Keep in mind, owner's equity consists of two parts, capital stock and retained earnings. For all intents and purposes, once we've created our capital stock, we don't change it unless we make additional investments or withdrawals from the business. So the account that's going to be changed is retained earnings. Okay. So retained earnings is usually going to be the account that gets changed. This is an income statement for a little bit more complex of a company than we've covered so far. Notice a couple of things. It is for a specified period of time. It tells us that it is the income statement, and it tells us it's for the year ended December 31st. Notice they have two revenue accounts. Very common. Most companies will have 2 or 3 or even more different revenue accounts. If I'm thinking of a gas station that both sells gas, perhaps sells convenience food and makes food, I can easily think of them having 3 revenue accounts. One for the gas pumps, another for the convenience foods that they sell, the Milky Way bars or whatever else, the sodas, and then a third one for the burgers they cook on the fry pan and back. So it would not be unheard of for them to have 2 or 3 or 10 revenue accounts. Expenses, notice here they have a number of expense accounts, and you can see really quickly right here we've got this really small business. They have 2 revenue accounts. They have 1, 2, 3, 4, 5, 6, 7, 8 expense accounts. They have 10 general ledger accounts, and we haven't even talked about all their accounts on the balance sheet. Even small companies will have probably at least 100 ledger accounts. Notice how they set this up. I have 175,000 in revenue. They listed all their expenses here, and then they put a subtotal out here of 108 grand, and that gives them their net income before tax. Then they subtract out their income tax. That gives them a net income after tax. A couple of quick notes here. When we're running some subtotals, we'll usually have one line, and 2 lines in accounting represent we're all done. So whenever you see 2 lines, that means we're all done. And this specifies how profitable this company was for the year ended December 31st, 2015. Usually we use accounting periods. Quarterly is common if you're a public company to at least report financials. In fact, you have to, but you may even do it monthly. Okay, you may even do it monthly, at least internally. Revenue works to increase owner's equity. Expenses work to decrease owner's equity. Because revenue increases owner's equity, and owner's equity usually has a credit balance, all revenue are going to be credits. Okay, when we talk revenue, it's almost always going to be a credit. And because expenses decrease owner's equity, and owner's equity, expenses are always debits. So as a general rule, and every once in a while there's an exception, but as a general rule, anytime you have some expense account, you know that it's going to be a debit. One other principle that we use here is the matching principle. We try to match revenue and expenses. Okay, we try to match revenue and expenses. So expenses are recorded in the period in which they're used up. Revenue is recorded when the service is rendered. So think about it. It's the end of the month. I bought 20 gallons of paint to paint the house, but I'm not going to paint it till next month. Okay, do I count it as an expense this month or next month? I count it next month. Why? Because that's when I'm going to use it up. That's when that's when they're going to be used up. They're going to be used next month. So even though I paid for them maybe last month, I'm going to record them as an expense when I use up those gallons of paint. And when do I count the revenue from that job? I count the revenue from the job when I actually go out and paint it. I may have collected the money in advance, but even though I collected the money in advance, I'm not going to count it as revenue until such time as I've actually earned it, did the work. Okay. So we're going to talk about accrual accounting more in either chapter 4 or 5. Okay. But the thing to realize is that when cash is received or paid, okay, the income statement reports revenue expense. Okay. Or the income, they were, the bottom line, is what we're going to do is we are going to match the income that we earn, the revenue that comes in, with the expenses of that. Okay, so even though I collect money in advance, until I earn it, it's not revenue. If I pay money in advance, it's not an expense until I actually use it. Okay, now I've already mentioned this. Okay, expenses are almost always debits. Expenses are almost always debits. Why? Because expenses are almost always going up. Now, every once in a while, will we have a credit for an expense? Yes, but does it occur very often? And the answer is no. Revenue is almost always a credit. Okay, only when a customer returns something or something like that will we debit revenue. Okay, so for the most part, revenue is always credited, expenses are always debited. Okay. I hate this textbook in one particular case. They spend far too much time on dividends, in my opinion. But it really illustrates some good points, so I understand it. So whenever we have dividends, we're going to debit them. And the reason why we're going to debit them is because it's going to decrease owner's equity. Okay. And for the most part, once we have capital stock, we don't, it's only a credit for an increase. Very seldom do we take money out, and so very seldom do we have to debit it. Okay, but owner's investments increase owner's equity, almost always a credit. Dividends are almost always going up, and by that I mean the total value of the total value that we have to account for. So dividends are almost always a debit as well. So let's take a look at a couple of transactions here. Advertising expense, okay? Expenses are always debits, okay? Expenses, the easiest way to think about an expense is it's always a debit, so that's going to show up on the debit side. We paid cash. Cash is an asset. To get an asset to go down, what do we need to do? We need to credit it, so we'll have to credit that asset. Had another advertising expense, $470. So what do? We have a debit for advertising expense for $470. In this particular case, I didn't pay cash. It's an accounts payable. I still owe them the money. So to owe them the money, what do I need to do? I need to credit my liability account, accounts payable, by $470. And so now notice the balance on that account is $7,470. Shop supplies. I purchased some shop supplies. Now notice it's not an expense. Okay, shop supplies are going to be an asset. Why? Because I'm going to use them over the next 3 or 4 months. I want to match my revenues to my expenses, so I put it in shop supplies for $1,400. When I use them up, I will count it as shop supplies expense. When am I going to use them up? Over the next 3 to 4 months, and at that point, that asset will turn into an expense. And notice I didn't pay for them yet. I didn't write a check, so my accounts payable is going to go up by another $1,400. So that's my credit. One other quick note: notice my debit was to shop supplies for $1,400. My credit was to accounts payable for $1,400. My debits and credits are equal. Keep in mind, I would have done a journal entry, and I would have done it in good form, as we discussed earlier in Chapter 3. I collected, in this case, $4,980 cash. So cash is going to go up. Cash is going to be my debit. And notice my revenue is going to go up by $4,980. To get revenue to go up, what do I need to do? I need to credit it. Why? Because revenue increases owner's equity. Owner's equity has a credit balance. So all my revenue accounts will, in order to get them to go up, are going to be credits as well. Let's see, $5,400. I haven't received the money yet. I'm going to receive it by March 10th. So my asset account, accounts receivable, is going to be debited. Why? Because it's an asset account. To get an asset to go up, I need to debit it. I sold these services, so my revenue is going to go up by $5,400. To get revenue to go up, I need to credit my revenue account. Have another expense here, salaries expense, or wages expense. Okay, so my wages expense, to get expenses to go up, I need to debit them. So I debit wages expense for $4,900, and my credit, I paid them. Okay, so my credit is to $4,900 for cash. I have another expense here, utilities expense. Utilities expenses are almost always debits. So whenever I see expense, that's going to be the account I debit. So utilities expense is my debit. My credit in this particular case, once again, I didn't pay them. If I would have paid them, my credit would have been to cash. In this particular case, I didn't pay them yet, so my credit is to accounts payable. Once again, debits and credits have to be equal, and sure enough, my $1,600 debit for utility expense is equal to my $1,600 credit for accounts payable. Dividends. The beauty is they declared the dividend and paid the dividend. We don't take it. It is not, dividends are not an expense. Okay. That being said, in order to get the dividends accounts to go up, what do I need to do? I need to debit them. Why? Because that'll push owner's equity down. When a company pays dividends, it's coming right out of owner's equity. To get owner's equity to go down, I need to debit my dividends account. And notice in this particular case, they paid cash. They paid $3,200 in cash. So what do I need to do? I need to credit cash for $3,200. The last item, or one of the last items we need to look at, is a trial balance. Trial balances are used internally, and notice it's a trial balance on a particular date, and all they do is list all the accounts. And they list balance sheet accounts, they list income statement accounts, And dividend accounts doesn't really show up in either spot, which is why I kind of left that one off. And all they do is they put the debits in one column, they put the credits in another column, and God willing, those two numbers will be equal. If they're not, there's an error someplace. That's the purpose of a trial balance. And we can see here that they're both $133,050, which is telling us that the debits and credits are equal. Doesn't tell us we did it right, but it does tell us that the debits and credits are equal. This is the entire accounting cycle. At this point, we've learned how to journalize transactions. Debits first, all the way to the left, credits second. Dollar amounts have to be equal. We've learned how to post them to the ledger account. So we've gone from the journal to the ledger, and we've prepared a trial balance. Okay. In chapter 4, we're going to make year-end adjustments. Okay. And then by the time we get to chapter 5 down here, we'll work on some closing entries. And by the time we're done with chapter 5, we will have seen the entire accounting cycle. Okay. Accountants spend a lot of time analyzing the data. The beauty of the computer systems we have today is they do a lot of the more mundane posting and what have you transactions for us, which is one of the reasons why we need accountants with bachelor's degrees, what have you, because they have much greater skills to analyze the financial statements, and that's where we need accountants today. That concludes the lecture for Chapter 3, Part 2. If you have any questions, please let me know.